So what is a fair value gap? A fair value gap is also known as a price inefficiency, is when there is an indifference between buy orders and sell orders in the market. In a way, it's a one-way stream market. One side is significantly more dominant than the other. Reasons are, for every order, there must be a counter order to fulfill it. So for a short time period, when the market is one-sided and an obvious dominance is displayed, is when an imbalance will be presented. An imbalance will always be visible to us as a lone candle. That lone candle is a representation of the institution transaction, which is one-sided due to the large orders. The market will always look to counterpair, and the areas of imbalance will always be targeted for the purpose of the market being balanced out. What your fair value gap is, the connection between the two wicks and your body is the separator, so the empty space is the fair value gap. And why does this occur? This occurs because an aggressive move forces the market to move quickly, which causes the market not to be offered on both sides fairly. So let's go over this example of a fair value gap. So often fair value gaps occur after a major supply or a demand zone. So here you have your major demand zone. Why is it our major demand zone? Because this is where orders were injected that are responsible for this entire move. Because we know that orders are often injected in the consolidation. So when price consolidates, this is when the institutions inject orders. It's where the orders come in, where they pick a direction, and if in this case, more buy orders were injected and price expanded. So where was price distributed unevenly? You can see here, this wick is not connecting with this wick, and all you see is buy orders. So this is our first fair value gap, and we have a second one between this wick and this wick. So now that we have these levels, what do we know for sure? What we know for certain is that these areas will act as a magnet. They will attract price. Price will be attracted to these areas to close them off and balance out the market. And again, price can run through them just for the sake of closing, or price can come in and reject. And we will cover both parties in a second. Let's just cover the basics. As you can see, price was attracted to this level and it closed off our gap. Right where our gap is, price closed off, and here price closed off the gap. So let's mark out our fair value gaps. Here you have as you can see, you have a wick, you have this wick, and you have this wick, and this is the empty lone candle. So this would be your fair value gap. So this is your first fair value gap. Now here you have another fair value gap. Where else do you see a fair value gap? Here this was a fair value gap, but it's already been claimed. Here you had a fair value gap that's been claimed. Even as the candle is forming, which you can see here, you can see a wick and then the candle closed right here. So what does that mean? That means this is a fair value gap. So what do we know by having all these fair value gaps? That these areas are magnets for price. Price will be attracted to these areas. And you will see a pullback into these areas. You can see price pulled back in this area, but did not close it, so we can still expect it to completely close it. Let's carry on. Price closed the area, now expand it. And the purpose of this is to balance out the market. So these fair value gaps are mandatory for price to run through them. Okay, what do we have here? We have a fair value gap where the wicks did not meet. What do we expect? We expect price to close out this area. Price closed this area. Now we're looking for another fair value gap. Now And look to the left. Do you see any fair value gaps? Not at all. Everything's been mitigated. All the wicks connected with the body part. Price closed the fair value gap and is continuing above. We have another fair value gap where the candle closed, and this is the previous candle. That means there's only buying pressure here. Price did not come and close out this area. Now price closed this area. Now you have another fair value gap. Price closed this area and came to attack our bullish fair value gap. Price closed this area and came back above. And that's the main purpose of a fair value gap. So these areas will attract price. So what you want to look for is price being attracted to these areas. And not only you can use them as entries, which we'll cover in a little bit, you could use them as a guideline to where price wants to go. So let's go over a rejection example of a fair value gap. So here you have your fair value gap where the wicks don't meet. And why in this case would you be looking for a rejection rather than a fill? Again, the motion is still exactly the same. Price will be attracted to this level as a magnet just because price needs embellishment. But why are you anticipating a reversal? Again, when looking for reversals, what you want to do is you want to pull out your fib and get the 50% of your fair value gap. Statistically, this is where price rejects from. A lot of times it rejects from the 50% of your fair value gap. So now that you have the 50%, what you want to look at is where is the fair value gap located? In this case, it's located inside of a shelf. So this is your shelf. This is your high. This is your low. This is where the orders were accumulated. So in this case, your fair value gap is located inside of your shelf. And what's another clue? Another clue is that this fair value gap overlaps with your breaker block, which would be your mitigation block right here. So the fact that this fair value gap overlaps with this breaker block inside of our shelf, this is extra confirmation that you could be looking for a rejection from this fair value gap, from the 50%. And that's the best time to trade fair value gaps. Now, when they're just lone fair value gaps is when they overlap with another internal liquidity, which could be your breaker block, which could be your order block, etc., etc. So here's an example of a overlap fair value gap, and this is where you would anticipate a rejection. Again, what is it overlapping with? It's overlapping with our breaker. So our breaker is right here, and this fair value gap is overlapping with our breaker. So that's the first clue. The second clue would be that this fair value gap is responsible for the structural breakout, breaking out of the shelf. This fair value gap was responsible. And one of the things that people ignore is the approachment. Again, if you look at how price approached this level, what you don't want to happen is you don't want price to spend too long trying to approach this level, consolidate, maybe start an uptrend, and then eventually come down. You would want a quick reaction, but not too quick. So you would want price maybe to consolidate for, let's say, an hour or two, and then drop, instead of consolidate here, then consolidate here again, then go up and then go down. Even though it might form an inducement, preferably with a overlap projection, you would want a direct approach. So let's take a look at how a fair value gap can also cause an inducement. So what we're looking at here is this fair value gap that is set inside of our shelf, which is our previous operating range. Price tried to push above, but consolidated here and went back down for more liquidity. And as you can see here, you have a reaction. Now, this reaction did not completely mitigate the entire fair value gap. It only touched the top quarter. So again, price is still incentivized to come back to this level. And the way we would look at it is this would be an inducement. Price can always still come back to this level, take out the liquidity right here of anybody that purchased price to go bullish, close out this gap completely, and then continue higher, or go down and target an extreme level order block right here to continue higher. So this is an inducement forced by closing out the gap, but not completely. And there's still, the market isn't fully balanced. So price does need to come back and close this level out. As you can see here, price mitigated the entire fair value gap and continued to the upside. And here you had your purge. So liquidity was purged. So here's another example of an inducement based off a fair value gap. So here you have your shelf, which is where the orders were injected. This is the source of your orders, and we're focused on this fair value gap. So what can happen now? Let's look at all the variance. So this could be an inducement for price to come down here a little bit, completely close your fair value gap to balance price out, and then continue down with the bearish trend. Now, another example is price could just continue dropping. And price can also reach your discounted level. And if price reaches your discounted level, then more than likely price will reverse and continue a micro bullish trend, even though the overall trend is bearish. And the last example would be price targeting your extreme breakaway order block. Price could target this order block, which price will come down here. Of course, it will not reach your discounted level, not the extreme and not even the regular discounted level. Reach your order block and then continue with the overall bearish trend. Again, the micro pullback, the important thing for your micro pullback is for it to not reach your discounted level. And I'm not talking about all the way to the extreme. Let's say price reaches somewhere here. This will nullify the trade, because once price gets enough discounted liquidity, price can always start a new micro bearish trend, at least until up to here, to take out this major liquidity. So that will nullify the trade. So let's take a look. Price closed the fair value gap and attacked your order block. To drop all the way down. Again, the inducement was right here. Price inducement dropped down, did not reach the 50%, came back up, closed the gap, and used the extreme order block to continue the bearish trend. So another way you could use fair value gaps, which is the way I personally use them, is as targets. So let's say you have a setup here that you want to take. Let's say all your criteria has been met. You had a market shift, and you have an inducement, and here you have an extreme OB. And here is your entry. Now, the way you would use your fair value gap here is you would look at it for a target, because you know that price is attracted. So not that you're using the order block just to catapult price, you're using your fair value gap as a magnet to pull price. So it's pressure both ways. So here's your fair value gap, and you know the major fair value gap concept here is that the price will be attracted to this level to fill up this gap. So this could be your take profit to close out this gap. And this will be a safe exit. Now again, the fair value gap as far as your target always have to be on the other end of the extreme. So again, this fair value gap as far as your target, it overlaps with your extreme. Price close the gap, and more than likely will now reverse, either come down, get more liquidity, or continue bearish. Another way you could use fair value gaps is to predict the daily bias. So now we're in the daily time frame, and I'm going to mark out my fair value gaps. We have a gap here, and we have another micro gap here. And the way we can get our bias is once price closes this gap completely and closes below, you can say the next day is alongside with the trend. So in this case, it would be bearish. So the next candle, daily candle, will be bearish, and so on. But like I explained on my website, as the days go by, the probability of your bias goes down. So your highest probability is the next day. Same with here. If price comes up here and closes this gap completely, the next day would be bearish. So let's go with it. Okay, so price closed this gap completely and closed this gap. So I anticipate the next day to be bearish. Here we have a bearish day. We have another bearish day. So now we have another fair value gap. Once price closes this gap, we can continue with the bearish trend. Price closed the fair value gap. That means the next day is bearish, and probably the day after that to continue the trend. So now we have one bearish day, two bearish days, three. Now we're looking for another fair value gap. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and comment what video you guys want next, and make sure you follow the free Telegram channel for the updates.